Since you're presumably watching this before the Fed meeting, which would be Wednesday, July 31st, and we're recording this about a week in advance of it. Right now, the thing to do is focus on that event going forward as pretty much the big macro event of the coming weeks. We've started to settle into the quiet summer doldrums, but there's just so much focus on this one meeting that's coming at the end of July that I think it's crucially important for investors to think about what scenarios might emerge from that meeting, and it's really kind of up to you to put probabilities on them. And then if you think that there's an outcome that's more likely than the others, or one that's particularly undesirable or desirable, adjust your portfolio in that direction. Right now, the market is pretty much convinced that we will see a 25 basis point cut in the Fed funds rate. There was some speculation last week after New York Fed Chairman Williams alluded to the possibility of a 50 basis point rate cut, and then it was quite clear that they circled the wagons afterwards and brought the market back to thinking about a 25 basis point cut. And I think the Fed at this point would be really loath to disappoint the market in a major way, and probably somewhat foolish to do so. So I would say that with very high certainty, we're looking at a 25 basis point cut. Fed fund futures and other similar short-term fixed income futures reflect that. We're basically seeing a 100% chance of a rate cut. There's still some residual probability placed on a 50 basis point move. Let's say 20% chance of a 50 basis point move, an 80% chance of a 25 basis point move. But that also adds up to 100% of some move altogether. The problem becomes then, what will they say? And this is where the outcomes really diverge, and this is where I think you get into some real risk. As you look forward at the Fed funds futures and euro dollars, et cetera, markets are pricing in somewhere between 3 and 4 25 basis point cuts over the next calendar year. The question we have to consider is why? There's certainly been jawboning out of the White House, but I think the Fed has been doing its best to try to assert its independence. So I would consider that as background noise for now. But then you have to get into the question of if there is the need for a 75 to 100 basis points cut going forward, what do they see on the horizon that would justify that? Is there some sort of negative slowdown, whether it's the U.S. economy or the global economy spilling over to the U.S., that would require essentially a fresh easing cycle? The flip side of that would be for the Fed to come out and say, here's your 25 basis points, enjoy it. We're going to go back to looking at the data and don't bother us for a while. That would probably be the least market-friendly outcome. Somewhere along that line would be a continuum of whether the Fed would be looking for something, whether the Fed will be guiding the market to continue looking for rate cuts or continue looking for data dependency. And if you're looking at data dependency, that might indicate that they could be a little behind the curve or that they're sanguine about the economy. I just simply don't have enough time in the scope of this video to do this. But those are the decisions you have to be making. And realistically, you can listen to a million talking heads, of which I would be just one of many. My personal opinion is I think the Fed is most likely to say, here's your 25 basis points, we're going to go back to data dependency. The reason for that being that we don't want to be pushing against the zero lower bound. There's really very little stomach to go negative. The problem with that is it may actually be considered the least friendly market alternative, because you would really require some major repricing of short-term fixed income. And once you reprice short-term fixed income, everything gets somewhat repriced. So take that with a grain of salt. As I said, that's the most likely outcome, but it's certainly not my call for a definitive outcome. But if you do think there's some probability of that, you really better take a look at your positioning and see where you're exposed to potential moves in the short-term interest rate curves and how that would spill back into your portfolio.